I'm Dan Danford. We're doing a series of podcasts for Dad's Divorce called Money Made Easy. We usually just take a question that's been posed by a viewer and I try to answer it as best I can. This one is pretty simple and straightforward. How do you go about picking investments for your 401k? Great question, because it's something that most of us deal with, because truthfully 401k plans are the most common plans that employers provide for retirement. One of the first things I'd say is that most of the investment choices in a 401k plan have already been pre-screened. In other words, the plan sponsor, the people who operate the plan, have narrowed the list of choices down to a fairly manageable number. So out of 25,000 different mutual funds or share classes, they've probably reduced your number of selections to 20 or 25. Okay? And all of those have probably met some kind of basic criteria as far as the costs involved are probably fairly low. The performance is probably fairly good. In general, these are going to be pretty good choices. So the real question for you or anybody else in a 401k is, which of those choices are most appropriate for your situation? Okay? In other words, out of the 20 or 25, what are the best choices for me? Now, here's what I've observed over many years, is most people are risk adverse. Most of us, if we're given a choice between something we perceive as risky and something we perceive as safe, we'll tend towards the safer choice. But that really hurts you in the retirement world. A couple of points. Most of us who retire, can look forward to a retirement time horizon of 25 or 30 years. Okay, that's a long time. Take that a step further and say, well, how old am I today? And here's one of the sad truths about your 401k plan. Money that you put in there today will have to be buying you prescription medicine 50 or 60 years down the road. Okay? Now, one of the problems is the safest choices don't tend to keep up with inflation over longer periods of time. Okay? So if you want to put $1 in today and know that it will buy $1's worth of medicine later on down the road, over 40 or 50 years, you may take $12 or $15 down the road to buy $1's worth of medicine today. So your money has to accumulate over that long period of time. So what we talk about is risk adjustment. And what we really need to do is we need to have some asset classes in our retirement portfolio that have a history of keeping up with inflation. In most cases, that means some kind of stock investments. Okay? So what we recommend to people is that you build a portfolio that includes different kinds of stocks in your portfolio. Now, when we build a portfolio, we basically look at 4 or 5 different areas. We want to have some stocks that are large company U.S. stocks. These would be the name brand things that you recognize. IBM, Hewlett-Packard, Microsoft. Well, those are all technology. But throw in some industrial type companies. The DuPonts, the big, maybe Caterpillar. Those are the big kinds of name brands that people recognize. Okay, those are the biggest and most stable part of the investment world. So those are what we call large cap stocks. And I would choose a manager that has some specialization in large cap stocks. We also think that you ought to have some mid cap and some smaller cap stocks. Now, history tells us that the smaller companies tend to outperform the larger companies. They just have more room to grow. So there are managers that specialize in small company stocks and also managers that specialize in mid-sized company stocks. And we'd want you to have both of those in your portfolio. We'd also suggest that you have some international stocks in your portfolio. In today's global environment, it no longer makes sense to have all your money in the United States of America. So you put some of your money in parts of the world that have economies that move on different pistons than the United States economy. Maybe when the U.S. economy is high, they're low, or maybe when we're low, they're high. But that helps stabilize the portfolio and gives you better growth potential. Now, the balance of your portfolio probably ought to be in high quality, short or intermediate term bonds. And the way to do that is with a bond portfolio. And most 401ks offer you a couple of different choices there. There's the money market, then there's probably a U.S. Treasury bond. And I'd have those in this portfolio. The younger you are, the lower you ought to have in that bond portion. Okay, if I'm designing a growth portfolio for somebody that's in their 20s or their 30s, that may be 15% of their portfolios in bonds and the rest of it's in different kinds of stocks. But that is the kind of portfolio that will create the most money for you when you retire and keep pace with inflation. One more thing that I'll talk about with 401ks, which is pretty important. When we talk about risk, what we're talking about in the investment world is portfolio volatility. In other words, it has to do with how steep is the roller coaster. Okay? And the bond portion of your portfolio tends to smooth the roller coaster. Okay? So if you're middle-aged and you're looking at it, you might have a portfolio that's 50% bonds and 50% stocks in various mutual funds. Okay? What I would say to you is volatility is actually good in a 401k. Okay? The reason is what we call dollar cost averaging. And what basically is if you're putting $100 a month into your plan, it makes you buy more shares when the market is low and buy fewer shares when the market is high. Okay? Now mathematically, that will grow you more money over time. So if your time horizon is 10, 15, 30 years till retirement, having a portfolio that fluctuates is actually good for you. It works in a 401k in ways that it doesn't work anyplace else. So my thing to you is when you build a portfolio for your 401k, space it out among those different asset classes and tend to be riskier rather than safer. That will build you more to retirement. One more option that I'll add that is what I call an autopilot, and it really fits for a lot of people today. Many 401ks offer an option that's called a life cycle or a target date fund, either one of those two. And basically what that is one mutual fund that already has the different asset classes I talked about, and they do it for different age groups within the portfolio. So if you're young and aggressive, they build a portfolio that is young and aggressive as well. If you're older and more safety oriented, they have a portfolio for that. Now the good thing about this is even with those different classes of portfolios, they're going to make sure that you have representation in all those other areas. That's really important for safety and diversification as you go forward. The thing that makes it work so well for a 401k is you don't have to mess with it. Okay? You just tell them you want 100% of your money going into that target date fund, or they call them life cycle funds as well, and you don't have to mess with it at all. Every month they'll put your money in that fund, and over time that fund will grow to what you need for your 401k when you get ready to retire. Now honestly, I spend a lot of time working with employee groups and talking to them about 401k investing. It really isn't rocket science, but my big key for most people is to be more aggressive than you think you want to be, because that will mean you have more money when you retire, and that money will last longer after you retire. Okay, that's it for another episode of Money Made Easy. We'll talk to you next week. Thanks.